Well, for those of you who are U.S. Canadian people, this is going to be really important, and I'm going to bring it up and I'm going to talk about it and try and do it for about 16 minutes. I'm going to try and do it for 16 minutes because at 7 o'clock we're expecting a couple of phone calls, and I don't know how long I'm going to go on after that. Depends on how many phone calls we have coming in, but I'm going to talk about this. Right now, when a Canadian goes to work in the States,
Don't forget to plug the chat.
oh, plug the chat. That's what that word was. I couldn't read your word.
Yes.
Okay.
Tell people to join the chat and ask questions through there, and we have one question already.
Oh, we do.
Yes.
Do you want to read the question to me?
I don't want to talk at all.
Well, you're going to have. Are you? Have you got your mic on?
Juju Scan said he has a question, but he hasn't asked it yet, so I'll ask him to ask the question.
Juju Scan, if you're on the line, ask the question in the chat. And how do you, tell me again, you go into chat because you've got you're on Ustream, you're watching this, and there's a place where you set yourself up with, I did this myself, so I know how to do it. I did this myself for you. And you set yourself up with the user login, and then you can join and you can ask the chat. Anybody who's made it onto the internet can find this out. And I'm going to try and cover most of this first, though, before I do that question. But if you're out there and you want to phone the station or phone us and ask a question, you can dial 866-980-0499. Maybe put that up on the screen. 866-980-0499. We'll put you on. We can answer your question on air. Or if you want to send one by chat, I can see the screen I've got over here for Richard's computer, and Mitchell will have to read it out. Mitchell's got laryngitis, and Richard went home sick, and so Mitchell and I are doing this program. And when I used to do the daily program, we had 18 people doing what Mitchell and I are doing just by ourselves right now. So I'm going to sort of talk. What happens is if a Canadian leaves and goes to work in the States, and 65,000 TN visas are issued every year, and another 20,000 H-1Bs, and another 10,000 L1s likely are issued every year for Canadians going to the States. And that's just new ones going out this year. It doesn't even include all the others that are being renewed, etc., etc. But when a Canadian leaves Canada in the present moment, they are considered to be a departing Canadian. They have to fill out a form called a T1161. And the T1161 is a form that lists all your assets. So what happens is, let's say that you bought 1,000 shares of XYZ Moose Pastures for $1,000, and when you move to the States, these shares are now worth $400,000. Even though you haven't sold them, the CRA says you're deemed to have sold them when you leave the country. And you're supposed to calculate the tax on there, on forms 1243 and 1244, and you can file a bank deposit or a guarantee of something, a bank guarantee. HSBC gives them out quite regularly, where you guarantee to pay the tax when you sell the shares, but you don't necessarily need to pay it as you leave. But what you do is you change the value for Canadian tax purposes at this point, because you paid 1,000, they're now worth 500,000, or you paid 10,000, they're now worth 500,000, or you paid 1,000, they're now worth $5,000. It doesn't matter what it is. You're deemed to have sold them, and there's a new value for the purposes of you having left the country. Now, you leave the country, you're supposed to fill in Form T1161 and do the tax return for showing what the profit on these deemed dispositions are. When you do that, you can leave security in the form of a bank bond or something. But you have another problem, because traditionally, when you went across the border, you've now paid tax to Canada, maybe, or deferred it if that's what you want to do. But you go to the States, and you're now living in the States. And 4 years later, you sell your shares that you paid 1,000 for that were now worth 50,000 when you crossed the border, and you paid tax to Canada, and now you sell them for $100,000. But you sell them 4 years later. The States traditionally has only allowed you to claim the $1,000 you paid for them in the first place. So you had a form of double taxation, and the double taxation was unclear. In 2000, they tried to come up with a decision on it. It didn't work very well. So what the United States has now done is tried to clear that up. So I'm going to read this out to you, and I will tell you that it's boring and it's hard to understand, but I'm going to read it out because we're going to have this on as a YouTube explanation, etc. And this is RevProc, Revenue Procedure is what it stands for, 2010-19. And it's specifically for people coming from Canada. Doesn't apply to you if you come from Australia or New Zealand to the States. Deemed dispositions by individuals emigrating from Canada and immigrating to the States. That part's not there. Section 1, the purpose. This revenue procedure provides guidance for individuals who emigrate from Canada and wish to make an election for U.S. federal income tax purposes under paragraph 7 of Article 13 of the Convention between the United States of America and Canada with respect to taxes on income and on capital, signed on September the 26th, 1980, as amended by protocols signed on June 14th, 1983, March 28th, 1984, March 17th, 1995, July 29th, 1997, and September 21st, 2007. And that's called the treaty. With respect to property that is subject to Canadian departure tax under Canada's deemed alienation rules, and then in brackets, the terms alienation and disposition are used interchangeably throughout this revenue procedure, close bracket. This guidance is limited to the circumstances described in the revenue procedure and therefore does not address other situations in which the election of under paragraph 7 of Article 13 may be available. So it doesn't include everything, but it includes lots. The background. Prior to amendment by the protocol signed on September 21st, 2007, the 2007 protocol, Article 13.7 of the treaty provided that where at any time an individual was treated for purpose of taxation by one contracting state as having disposed of property and was taxed in that state by reason thereof, and the domestic law of the other contracting state at such time deferred but did not forgive taxation, that individual could elect on his annual return of income for the year of such disposition to be liable to tax in the other contracting state in that year as if he had immediately before that time sold and repurchased such property for an amount equal to its fair market value at that time. I'm not sure what it means either. Instances of double but, here's what happened. Instances of double taxation arose under the prior version of Article 13.7. Canadian residents who emigrated from Canada to the United States and paid Canadian departure tax on a deemed disposition of their property could not elect to be liable for U.S. federal income tax on deemed disposition of their property if they were not U.S. citizens immediately before they ceased to be residents of Canada, who would not otherwise have been subject to U.S. federal income tax on a disposition of the property. So a U.S. citizen who is moving down to the States could take advantage of Article 13.7, but a Canadian citizen couldn't. So instances of double taxation, Article 13.7 was amended by the 2007 protocol, the new Article 13.7, to provide that where at any time, an individual is treated for purposes of taxation by one contracting state as having disposed of a property and is taxed in that state by reason thereof, the individual may elect to be treated for the purposes of taxation in the other contracting state in the year that includes that time and all subsequent years as if the individual had immediately before that time sold or repurchased the property for an amount equal to its fair market value at that time. Thus, under Article 13.7, the election is now available to any individual who emigrates from Canada to the United States, without regard to whether the individual is a U.S. citizen immediately before ceasing to be a resident of Canada or would otherwise have been subject to U.S. federal income tax on disposition of property. Now, I want to make it clear that there's 9 pages here, and I've only touched on one page, not even a full page yet. I'm not going to read 9 pages to you. But let's get it straight. When we go through the rest of this thing, what you find out is that you have to make an election with your first U.S. tax return. And if you don't make the election, you're not eligible for the tax treatment. So it's really important to make the election. And I'm just